How do we know it's a longer term trader who is active at advantageous prices? What the book says is that only traders with a longer time frame, in other words, those who don't have to trade today, can take a chance on making their trade in an area where the market doesn't spend much time. If you have to trade today, you can count on being able to enter your trade in a low volume, basically unfair area. The high volume area where the market spends most of its time provides the liquidity you need. So as per the usual analysis, he says, and that this is referring to our analysis, we say smart money long-term traders require liquidity, but above statement says opposite. What to infer? So if I have to simplify his question, okay, what he's saying is that the CBOT Handbook, what it is telling us is that if you are an intraday trader, you try to or you prefer to trade in the value area, and if you are a higher time frame trader, only then you will trade in these areas where the volume is not high, because this is the most accepted price for the day, and these prices are not finding much participation. So now for intraday context, if you buy here, you are buying at a disadvantageous price, and if you sell here, you are selling at a disadvantageous price. So what Jim Dalton says is that, let's say market is moving sideways. This is shorter time frame trading, and when the other time frame comes in, market breaks out. So what he says, this particular move is created by other time frame traders or higher time frame traders. So how I understand it is, how will you know that whatever buying that is coming in here or whatever is causing the markets to go higher is sustainable or not? Because we all have tried to buy the breakouts and the breakouts have failed. So how do you prevent this? So my logic was that if the higher time frames start chasing the price, so let's say that higher time frame traders are interested in buying here because they believe the market is going to go much higher. Okay, if they know that the market is going to go much higher, they don't need this price action to confirm it to them, because they are not looking at price charts, they are not looking at technical analysis. What they are looking at macro principles, they are looking at rebalancing their portfolio, they are looking at adjusting their exposures to different markets. That is what big money is doing. They are not looking at charts. Or the people who are looking at charts, their volume is not going to create much of an impact. So if, let's say, smart money knows the prices are going to go in this region, they know it here also and they know it here also. So when the market is moving, they know that, okay, price is going here. When the price is consolidating, they know that price is going to go here still. Why? Because they are buying. Now they are smart money, and other smart money are also thinking on same lines, on practically the same macroeconomic pieces of information. So they know that other smart money is also buying. Now how do they confirm? They confirm with test. Now if they have all these kind of information know-how, then does it really make sense to say that they are buying here? Or does it really make sense for smart money to buy here? What happens? Let's say they start buying 100,000 contracts from this point, this breakout onwards. The liquidity is very poor here. Market is moving sharply. Will they be able to accommodate 100,000 contracts? No, they cannot. Okay. So they have no, let's say they get 10,000 here, and let's say 50,000 here, and then let's say 40,000 here. What is it doing to their average price? It is destroying their average price. And let's say market fails, then they are underwater. So will they do this kind of behavior? This is classic retail behavior. Don't you know that retail traders chase the price? Don't you know that retail traders try to buy breakouts? Don't you know that retail traders wait for typical confirmation which is completely different from what we look at? My logic was that smart money, knowing that their actions is what going to affect the markets, they will try to minimize the impact of their actions on the market prices. And where can they find good amount of volume? Now volume as in not vertical volume. Volume spaced out in time. When volume is spaced out in time, it looks like a volume profile. So they don't want to buy it all at once. So they are buying in smaller chunks here and there so that they don't affect the market prices too much. And once over a period of time they have accumulated their position, which will end up forming the value area invariably, what will happen? Then the market will start moving higher and it will eventually reach this level. When the market is moving higher, obviously some intermediate supply will come in. That supply will not be of huge quantity, and they will also not be interested in trading in those levels, because now they want to get an exit. So they want to draw in more and more participants. Where do you think they can draw in more participants? If they go beyond important references, if they go in a new high territory, if there is a strong momentum to the price move. So what happens? Let's say there is a consolidation, market moves higher and consolidates again. Do you think this will be considered as good momentum? Even in market profile, we know this is a double distribution profile which does not indicate good momentum. And we use this information. So they don't want this. They want the prices to move freely towards this reference. Why? Because this might be a previous high where there might be some buy stops above that. So if they want to sell, they want the other side to be buyers. So either they will liquidate in these buy stops, or when it goes above an important reference with good momentum, retail traders will chase the price there also. They will add to their trades also. And that is where they will be liquidating their positions which they have accumulated in this consolidation. So now what the CBOT handbook is trying to tell you is this is the confirmation. This is the confirmation. I firmly believe that majority of smart money buying is done in this area. What they are referring to is probably absorption of supply on shorter time frame, not very high time frame. Like any supply that comes in which is not strong enough, which the smart money can make out is just profit booking because it is not met with follow through selling. Then what happens? Then they will keep absorbing that, and that kind of buying will happen when the market is rising in higher with momentum or falling lower with momentum. So that is what they are referring to. I can completely agree that what I am saying is not exactly what is written in the CBOT handbook. Now I will take full responsibility of that, and I will say that with my market experience, and I have gone through this CBOT handbook hundreds of times back in the day. I have learned from it a lot. Now that I have a clear logical explanation for how the market might be working behind the scenes, how the smart money might be working behind the scenes, I don't find the need to again go back and validate my analysis with what is written in that handbook. Okay, again, that handbook is quite old. So just because CBOT has written it does not make it the final word. So I'm not saying it's completely wrong, or whatever way they are approaching or observing the markets is completely wrong. But what I have gleaned over the almost 2 decade long experience that I have, and almost a decade long experience or more than that I have with market profile, is the fact that the smart money buys during consolidations, and then they keep absorbing some small bouts of selling if they come in once the breakout starts, or if it is breaking down, then they'll absorb small bouts of buying or profit booking, and then they will continue the markets high. So this is how I look at it. Okay, and it is different from what the CBOT handbook is telling, and I take full responsibility. I have given enough logical evidence or proof to support my argument, and it's logical. I don't have I cannot get all the traders who are trading on any given point in time to give testimony to what I'm saying, but what I have said gives me a very sound foundation of taking decisions in the markets. All right, and I'm not also saying that every decision I take is correct, and that is why what I'm saying is the truth. I'm not saying that. I have tried to find a alternative logical explanation to this, and I am not able to find one as reliable as the one that I have just shared with you. So that is why I am sticking to this, and in majority of cases it works. Even if it does not work, it gives me information that I can then use to adjust my positions, manage my positions, or altogether reverse my positions, or take some prudent trading decisions in the market that either helps me preserve my capital or helps me grow my capital. Obviously, you know me for a long time, so you know that I'm not about entries, exits, and all those kinds of stupid things. But this is what I firmly believe in, and this is what really helps me trade in real-time markets. Okay, so I'm standing by it. I have given you the explanation. If you have follow-up questions to this, obviously you are most welcome, and we can have a discussion in the comment section below this video.